Good day, everyone. My name is David Williams, Executive Director of the International Association for Energy Economics. It gives me great pleasure to welcome you to today's webinar entitled Oil in the Crosshairs. We are grateful to our moderator and speaker, Clay Seigle, as well as Suzanne Danforth for today's timely discussion. First, a little bit about the International Association for Energy Economics. We are the largest association specializing in the field of energy economics and provide a forum for the exchange of ideas, experience, and issues among professionals interested in the field. The organization produces 2 professional journals, a newsletter, and holds conferences and virtual presentations, along with a host of other products and services that you can find at our website at www.iaee.org. If you're not already a member of the association, we welcome you to join. A few housekeeping matters in regard to today's webinar before I hand things over to our moderator and speaker. First, this webinar is being recorded for those that cannot participate in today's live event. If you have questions for our moderator or speaker, please use Zoom's Q&A option at the bottom of your Zoom window to make known your question. We've allocated sufficient time at the end of this webinar to address your questions. And now it's my great pleasure to introduce you to our moderator and speaker, Clay Seigle, Managing Director of Vortex's Businesses in the Americas. We're grateful to Vortex as well for co-sponsoring this webinar with IAEE. Clay, over to you.
Thank you, Dave. Good morning, everyone. Give me just one moment to share my screen. Good. Hopefully everyone can see my display with the title page, Oil in the Crosshairs. Let me get started by first of all thanking IAEE for hosting this session and inviting us to present today. I'm grateful for the opportunity. We have a very interesting presentation, 2 presentations actually, about the increasing tempo of attacks on oil assets. After a really short introduction about my company, Vortexa, I'm going to describe the important historical context of oil in the crosshairs in order to give us the proper perspective about what we've been seeing more recently. I'm also going to suggest a framework for interpreting how oil prices are likely to react based on certain conditions in the oil market. And then I'm going to mention a couple of, I think, important themes that are shaping the oil industry landscape and the effect of those themes and even policies on future oil prices. Before I get started with these key messages, Vortexa is an energy intelligence firm. We focus on the global waterborne oil and gas trade. And we combine a sophisticated artificial intelligence platform with really deep industry expertise in order to generate and provide valuable intelligence on seaborne energy movements. Our platform helps our clients forecast supply and demand changes, monitor the operations of their customers and other third parties, identify business development opportunities, and just generally make better informed decisions. Our clients are oil and gas traders and market analysts, tanker charterers and fleet operators, as well as financial investors in both the energy and the shipping segments. Our company is headquartered in London, and our Americas division is based in Houston. So I would invite everyone in today's audience to contact us at vortexa.com in order to either continue the discussion that we're starting here today or to open a new dialogue. We'd be very happy to hear from you. So the key messages that we're going to look at today, first of all, in a way, this is nothing new. Oil has, unfortunately, come under fire, found itself in the crosshairs for quite a long time. But the tempo is increasing, and that is cause for concern. How much of a concern? It depends, at the end of the day, on how tight the supply-demand balance is. And specifically, we tend to focus on the disposition of global oil inventories and spare production capacity that's substantially held by a few countries within OPEC. The oil market is also facing, you could say, multiple and myriad sources of threats these days. They range from explosive mines and rocket fire, all the way now to, as we've seen quite recently, the cyber realm. And so this formidable array of threats, it can't be mitigated by either industry or government alone in isolation. It is going to require close and effective collaboration between them. So let's roll up our sleeves and take a look here. Now, don't worry, don't get intimidated. I'm not going to go into too long of a history lesson here, but I want to provide the long-term context for what we're seeing recently. The truth is that oil has found itself in the crosshairs, in the sights, really ever since it became the primary fuel of the world's armed forces. So in order to remember when that transition was taking place, we have to rewind the clock, turn back the chapters of the history book to that interwar period, that period between the world wars last century. So we're just going to touch on this a little bit because really important context for understanding what's going on today. Let's remember what military forces were kind of working on back then, on land, sea, and in the air, okay? Because this period is really when the armies of the world start to use trucks to move their soldiers faster and farther than the previous mode of transportation, which for that kind of the final mile to the battlefield after they had already moved by rail was still horse-drawn in those times. So we now have the scale production of trucks for battlefield use. We also have the scale production of that machine, that awesome combination of firepower and movement, which is the main battle tank. And the tank, like the truck, are powered by oil. So I think you start to see where I'm going with this. In the skies, right, military aviation is going to be transformed from what was kind of a provisional experiment in the First World War to a main engine, a main nexus of combat firepower, and also the movement of troops and equipment. And of course, those aircraft are fueled by oil and oil products. And then at sea, again, we have basically a permanent demand destruction for coal taking place as oil-fired engines are now propelling the navies of the world. So where I'm going with all this is it's really no surprise that it's during the Second World War that we see major efforts to disrupt adversaries' fuel supplies. And it's those new supply chains, kind of what the military calls lines of communication, that now include oil, that really influence the war's outcome in so many ways. So this is the first time that oil is really coming under fire in a big way. And it's because the oil in some ways can't keep up with the advances of the armies on like tactically and operationally on the battlefield. So I'm sure you all remember from your history, famously, the German army invading Russia would get out ahead of its supply lines into deadly winter conditions. Problem, right? And years later, the Allied armies that are moving through France would also outrun their supplies, setting up, legendary, an opportunity for Axis counterattack at the Battle of the Bulge. But a couple of really important milestones of oil under fire to look at on this graphic. In the Western theater, we have the Battle of the Atlantic. A subset of that is a Battle of the Caribbean. And German submarines are very effective against Allied shipping of war materiel, including oil. 20-something oil tankers are sunk in the Atlantic and the Caribbean. And the refineries in the Caribbean are also coming under Axis fire. And then for their part, the Allies, they recognize the importance of targeting oil as part of the war effort. They are so determined to deny the Axis the fuel that's needed for its war machine that they plan a special operation. It's codenamed Tidal Wave. And this is an operation to bomb the Axis-controlled oil refineries around the Romanian city of Ploiești. So they carry out these daring raids, a series of them, but the operation came at a really high cost to the Allied attackers. Hundreds of lives in air crews devoted to these missions, dozens of aircraft sacrificed in order to hit these oil targets. There's some other important milestones here on the slide that are related to major conflagrations, Korea, Vietnam, and the Middle East. But what I really want to highlight on this timetable is the long intervals that we see between significant attacks against oil assets in the post-war period. This list is highlights. It's just a sample. It's not comprehensive. But the key here is that oil was not being attacked very often in previous decades. It was mostly during major wars. Now, more recently, however, the pace has increased. And so the past 3 years or so have seen a pickup in oil and gas assets being deliberately targeted. So let's look at a few of the major flashpoints here, right? Hostilities during the Civil War kept the Libyan oil industry disrupted for several years in aggregate, and it was actually virtually shut in for most of last year, for 2020. When we think about Saudi Arabia in recent months and quarters, Saudi Arabia has fired quite a few air defense missiles in recent months as Houthi forces that are based in Yemen have attacked multiple Saudi Aramco facilities. And all of these that I'm referring to here come after the more spectacular attack on Aramco's Abqaiq processing facility that you'll remember from 2019. And then in the Gulf, more than 30 years after, if you remember the name Operation Earnest Will, and the escorting of reflagged Kuwaiti tankers by the United States and a coalition, it's still the case that seaborne oil transport is still coming under attack. And you'll see here on our timeline, in and near the Strait of Hormuz, as I mentioned, from old technologies like limpet mines attached to the sides of the ships or positioned in the ocean. And on occasion, we've also seen tankers towed into custody by an armed naval unit, be it Iranian or American, etc. And speaking of the diverse threat matrix, the really interesting phenomenon in recent years, the raiding of oil tanker ships by pirates has become such a severe threat to oil transportation worldwide that tanker operators have taken to repurposing one of their safety technologies in an attempt to scare away attackers. Okay, that all these ships have a technology, a beacon called Automatic Identification System, or AIS. And it's broadcasting at all times statistics, fields about the ship, where it's been, where it's headed, how fast it's going, it's heading. And a lot of them are hardwired to the instrument of the ship, but one of the fields that is being broadcast by these beacons is a free text entry where the captains are supposed to enter their destination, right? And Rotterdam, New York, whatever it happens to be, Gibraltar. Many of the captains, especially when they're transiting these trouble spots, like around the Horn of Africa, are instead using that destination field to enter the words "armed guards on board" instead of a destination. And they're broadcasting that deterrence signal to anyone receiving the message. How widespread is this? At Vortexa, I asked the guys to look into this. At Vortexa, our networks received nearly 250,000 such messages, armed guards on board or related, just last month, during May. Oh, and speaking of May, right? Let's double click on May. We saw last month multiple attacks and types of attacks on oil. So for the first time, oil and gas facilities in Israel during one of the flare-ups in Arab-Israeli fighting, facilities both onshore and offshore were deliberately targeted by military forces firing rockets in Gaza. And of course, last month, we have the now famous cyber attack on Colonial Pipeline that compelled its operator to halt fuels transportation for a period of days, many long days, which, along with some hoarding behavior on the retail side, caused acute gasoline shortages throughout many metro areas of the southeastern United States. So that brings us up to present day. Now, let's talk about the oil market's cushions, or shock absorbers, if you will. This is a metaphor that I didn't make up. It's been around for many years, but I think that this is a good one. And let's face it, right? Oil supply disruptions and problems with oil producing and midstream assets, they're an inevitable part of oil market life. But what's interesting is their effect on oil prices has really varied greatly over the years, over time. Now, I'm going to posit that the most important determinant of the price effect is the status or the condition of the oil market's cushions or shock absorbers at the time the disruption occurs. And the oil market basically has two. Okay? It's got inventories and it's got spare capacity. So let's take those one at a time. There are lots of kinds of oil inventories. There are crude oil inventories and refined product inventories. There are those that are government held, and there are those that are commercially operated by private companies. But the bottom line is that when a disruption occurs, or when there is an elevated risk of disruption, oil traders, the people who are buying and selling and setting prices of oil and the related futures contracts, also important here, they are naturally going to consider how much oil is on hand in storage tanks that could be drawn down and brought into the physical market in order to offset the production loss. And generally speaking, today's oil inventory levels are certainly ample at kind of the headline view, but they have drawn down. They are lower compared to the very high levels that we reached in 2020. And the outlook for oil inventories, as global oil demand is expected to rebound by the end of this year to approximately, more or less, near 100 million barrels per day. It might be somewhat less, but 100 million barrels per day is that kind of that magic pre-pandemic level on an annual average basis. So that's on the oil demand rebound side. And also consider that markets, they seem to be poised right now to maintain their, what we call a backwardated term structure, which is really just a fancy way of saying that oil price today is higher in price than oil that's contracted for future delivery. So that condition, that kind of price differential across the time horizon, that seems likely to endure right now. So in that case of a backwardated market, in addition to oil demand rebounding, it seems like a reasonable assumption that oil inventories are going to further decline during the second half of the year. All right. The second kind of shock absorber to smooth the oil market's path is spare production capacity. And this is basically held by just a few countries in the Mideast Gulf, primarily, foremost among which is Saudi Arabia. And this is another case where the market is going to establish prices when it's faced with a supply disruption, at least on the crude side, considering whether and to what extent offsetting production capacity can be brought online. And the near-term outlook for spare capacity is probably to decline a bit as the oil market continues to tighten this year, and as OPEC continues its current program of production increases during the summer. That's already been agreed, and it's being gradually implemented during the summer months, and then possibly even more of that to come later this year, to be decided based on emerging conditions. Now, let's take a closer look at spare capacity over the years. I'm going to tell you a trick here. We oil market analysts can look at a time series of OPEC spare capacity, and just from this view alone, from one metric, we can narrate the changing oil market storyline through the years. And I want to do just a quick review here so that you can appreciate that when spare capacity is low and production is perceived to be at risk, like in the mid 2000s, prices can get very high. Now, spare capacity peaked in this graphic first in 1999. What was happening then? Oil demand had cratered under the weight of the Asian financial crisis caused by currency, liquidity, balance of payments. You remember that chapter. And then again in 2002, this is following 9/11, had a halt in air traffic and a lot of mobility altogether for a while. And OPEC is going to step in to balance the market during that time period. A really important one to focus on here, though, is in the early 2000s, spare capacity is going to fall to record low levels. This is when the growth rate of China's oil consumption is just exploding one year to the next. And in these years, we also have multiple supply constraints that are affecting market prices. They're being priced in. And OPEC is going to react by adding supply. That's what's going on in that time period. And the price effect, think about what happened. It seems a long way away from what we've seen recently. But in 2008, I think that was the year that we hit $147 per barrel at one point. And I think that for the whole year, 2008, we averaged about $92 a barrel. So then what happens after that? Why the spike that we see in spare capacity starting in 2008, 2009, the Great Recession, right? That takes oil demand down. OPEC is going to struggle a little bit to rebalance. We have tighter markets again for a few years. Oil prices average more or less around $100 a barrel. Spare capacity is lower. And then we have a big downturn in price in 2016. And what's going on there? Of course, U.S. shale, tight oil, unconventionals are revolutionizing the industry. Output skyrockets from the U.S., big non-OPEC producer by that point. OPEC pulls back supply, and we see an increase in spare capacity. We then kind of muddle along, relatively balanced, more or less, until you know what happens next. The pandemic hits, and we see the largest OPEC and friends, OPEC plus, supply cuts ever undertaken. And these are what cause spare capacity to surge more recently. So the takeaway here is that future disruptions, when oil comes under the gun, under the crosshairs, in those future disruptions also, they're going to be seen, at least partially, through this lens of available spare capacity and its potential, if needed, to compensate. And just remember that as spare capacity decreases, the price effects of future disruptions or perceived risk of disruptions are likely to be more acute. All right, let's take a look here at some of the factors that could amplify the price effects from future disruptions in cases where oil and gas are found to be in the sights, in the crosshairs, right? And the most important theme I think that we need to talk about here is decarbonization generally. And so I think we can all agree energy companies are already and will be aggressively implementing ESG strategies that are going to increase the cost of adding new production capacity. And they're very likely to slow oil supply growth, at least. And I think we're going to see, again, a significant chunk of the continuing investment that takes place in the upstream sector is going to be diverted, repurposed from growing and maintaining production rates to these initiatives to mitigate greenhouse gas emissions by design, of course. So that's on the supply side. On the demand side, to be sure, decarbonization strategies certainly contemplate and aim for reductions in oil demand. I think the concern here is the potential for a misalignment. The concern is that demand does not decrease at the same pace as supply. So in other words, supply is going to move lower and demand does not or does not as much as supply does. So again, I'm talking to a sophisticated audience here today, but right, you don't have to be a PhD economist to know what happens next in a commodity market when supply is not meeting demand, net of inventory changes. It's likely that prices will move higher and potentially significantly higher. And when prices move higher, inventories are going to be further drawn down, and so too will spare capacity as remaining production is put into place to meet those higher prices. And so where I'm going with all this is this means that when oil assets come under fire in the future, price spikes are more likely to occur. Now, let's also have a word, as we're talking about these big themes, about the proliferation of risks for oil assets. And I guess the unfortunate reality is energy, generally speaking, already is and will continue to be one of the highest profile economic sectors that can be attacked, that's prone to attack. And those parties, those people, groups that are seeking to do harm to the industry, they have in this day and age a growing arsenal of weapons that needs to be considered here. It used to be that militias, armed groups, armed forces were just not able to target oil assets in other countries to a certain extent. The distances, the geographical space between them was just too far with the weapons that they had in hand. And then even aside from distance, the accuracy of where to deliver the ordnance was just not sufficient to hit specific targets. And I think we can see from the evidence on some of the previous timelines and the headlines, that's really changed in today's world. Today is a world of guided missile proliferation, indigenous manufacture of a lot of these weapon systems in many different countries by many different groups. And of course, we have big proliferation of a relatively new technology, unmanned aerial vehicles or drone platforms and the related technology. So yeah, here's the reality. I mean, now that bad guys have these substantial arrows in their quiver, it's going to require defense planners and strategists to really rethink, when we talk about protecting oil, everything. They need to rethink everything from regional and local air defenses to speeding up the development of and then adopting drone jamming technologies, right? Anti-drone technologies in order to protect those oil assets from these new threats that will, I think, unfortunately continue to bring oil into the crosshairs. And then, like, if this wasn't enough, as we just saw last month with Colonial, we now have to also contend with the cyber sphere and the prospect of digital disruptions and data disruptions as affects oil. So, here too, as technology marches on and as grievances in the world remain, more oil targets will be vulnerable to coming under fire from the cyber side. And by the way, this, what we just saw, might be a limited taste of the future. I hope not, but future attackers might not be motivated by ransom money. I mean, the economic disruption may actually be their end game. And so in future cases, just making a payment, we can talk about the merits and the moral hazard and stuff, but making a payment to restore the status quo for oil operations might not be an option. So let me say a few words about this, and then really want to transition to my co-presenter here today. But a couple of ideas, what can be done on the cyber front. I think it starts at the 50,000 foot view, recasting our perspective. Keeping oil assets out of the line of fire has to be seen as a vital national security interest. And I talked about the partnership between government and industry that's going to be required here. But the federal government is going to have to impose minimum safety standards. And I think that we saw this start to get done in last month's executive order that was issued by President Biden. And it's a lengthy document, but just one line here for the group today. It is the policy of my administration that the prevention, detection, assessment, and remediation of cyber incidents is a top priority and essential to national and economic security. The executive order calls for a lot of tougher standards for software that's sold to government. It calls for greater encryption among private companies' data management, and also a important review panel to spot and to solve gaps that develop. But I think that this is a step in the right direction here. And the bottom line is that oil companies are going to be required to undertake additional measures and spending in order to harden their defenses, harden their systems against infiltration and against data compromise. So it can't be every company deciding for itself. I think we can expect federal regulations to facilitate minimum standards across the board, really by all stakeholders in the industry, large and small. So we covered a lot of ground today. We put the recent attacks against oil infrastructure in context. I think we understand the importance of those shock absorbers, those cushions in the oil market, inventories and spare capacity, and how we're going to have to think about the emerging threat matrix along with the deployment of ESG priorities and the change in capital spending for oil companies that's going to result. What I'd like to do right now is turn the floor over to my co-presenter, Suzanne Danforth, from Wood Mackenzie. Suzanne is a former colleague and a friend of mine, and I'm excited to have her join our presentation and our discussion today. So let me stop share here and turn the floor over to Suzanne.
Thanks, Clay, and good morning, good afternoon, good evening, wherever you are. As Clay mentioned, my name is Suzanne Danforth. I am the Americas Markets Lead for downstream oil at Wood Mackenzie, responsible for managing and also developing the analysis on short-term and long-term outlooks for the Americas for refinery supply as well as demand. So before I start, and I'm going to be doing more of a deep dive into the interdependencies between regions and dependencies on imports within that broad US supply chain, the world's largest oil consumer. And that's going to talk a bit about, what does this mean for vulnerabilities when it comes to asset-specific supply disruptions. So a little bit about Wood Mackenzie. Wood Mackenzie, we have a global presence. We're positioned to support consumers, producers, and financiers of the new energy economy. So we have over 600 sector dedicated analysts on the research side, providing content both on an immediate term with the recent acquisition of Genscape, looking at near real-time fundamentals, as well as outlooks and insights on short-term commodity development, short-term commodity supply, demand fundamentals, and price, as well as long-term views out to 2050. We have a growing and large energy transition group that we work closely in the commodity groups, especially within the oils and NGL group that I work in. To ensure that we are, providing insight into, what Clay talked about with ESG around that energy transition, both on the supply and demand side, and what that might mean for supply demand balances for price going forward. So first, I'm going to start with Colonial Pipeline, which is a little bit where Clay ended up. So Colonial Pipeline, to give some background, it's a large system that feeds both gasoline distillate from the large U.S. Gulf Coast refining center, the largest refining center in the U.S., through the Southeast and ending in New York Harbor. And from Houston, Pasadena, Texas is actually the injection point. You have it, and you have refineries and traders, et cetera, blenders, loading supply into the pipeline in the Gulf Coast, around where the refining centers and the terminals are, and then delivering product into Alabama, Georgia, and all the way north. The line that ends in Greensboro, North Carolina, is 1.6 million barrels a day of gasoline capacity and 1.2 million barrels a day of distillate. That includes both diesel and jet. And these inland areas, especially areas like Tennessee, Atlanta, there isn't any refining capacity nearby, and they depend on Colonial Pipeline for these deliveries. From Greensboro north, lines 3 and 4 carry additional product north, with line 3 heading all the way into New York Harbor. And New York Harbor, of course, is one of the main pricing benchmarks points in the global oil market when it comes to refined products. And also it is the delivery location for the CME futures contracts that are also pricing benchmarks globally as well. So when this pipeline was shut for about 6 days, from Friday, May 6th until the following Wednesday, we had a sudden stoppage in deliveries of gasoline, distillate to all these points in the southeastern U.S. as well as the mid-Atlantic, all the way up into New York Harbor. And what this translated into, of course, is having to draw on stocks. So the charts on the left at Wood Mackenzie, the legacy Genscape products, we fly over and use imagery to track New York Harbor product storage. As again, this is a very important pricing benchmark location. It's the delivery location for the futures contracts. And as you can see with that orange dotted line there, the capacity utilization fell significantly. Levels we hadn't seen in several years, as that sudden flow of product that ends up, that terminus being in New York Harbor, was suddenly stopped. And I'll get into a little bit in the next slide why there are these interdependencies between these regions. But just to note, in the case of the refining center, the sole refining center in Pad 1, which we call the US East Coast, is in that mid-Atlantic region. And the last few years, we've had refinery closures. There was the Philadelphia Energy Solutions fire in summer of 2019. So you already have a market that's reliant both on waterborne imports from elsewhere in the world, primarily Europe, but takes product from elsewhere when prices get high enough, as well as that reliance on consistent flows from the Gulf Coast north. And so I'll talk a little bit in later slides about, sort of what this means, these interdependencies mean when it comes to the interconnections between regions in the US. So what was the result of that outage? The outage was only 5 to 6 days. We've had examples in the past of when a shutdown of Colonial Pipeline was far longer in terms of duration and had a much more acute effect. And this was in fall of 2016, where there was construction on the pipeline. A backhoe actually punctured the pipeline, and lines 1 and 2, those major trunk lines in Alabama, were shut for several weeks. And this led to severe gasoline shortages and fuel shortages in the Southeast, particularly in Tennessee and Georgia, those inland areas that are dependent upon there. And we even saw, with that long of an outage, waterborne imports of gasoline, diesel, and even jet fuel coming into Savannah and Charleston to then be trucked north to these terminals. Now, we didn't see that happen this time because the outage was so short, but we did see an increase in the flow of waterborne imports into Pad 1, which is the U.S. East Coast. Primarily, gasoline, of course, being that largest, as well as that, as you can see in the chart on the left, with the typical arrivals of Pad 3 to the Pad 1 flows. What we usually see in May, which of course is that's the beginning of the summer demand season for gasoline, and we've actually seen demand returning now to more of pre-crisis levels following the hit from the pandemic last year. You have a typical 1.8 to 2 million barrel a day flow of gasoline from Pad 3 to Pad 1. That includes both Colonial and the Plantation line that ends in Virginia, and that fell significantly. So the cushion there was pulling additional waterborne imports of gasoline as well as diesel from the East Coast. Now, in the Gulf Coast, of course, supply is backing up in the Gulf Coast. So what we saw there was refineries having to cut their runs slightly and also increase their export flows to sort of manage the backup of supply. And this was really on the heels of refineries just recovering, as you can see here, from the Texas freeze, which I'll talk a bit about electricity grids later in the presentation. But that was a significant hit, and refineries had just begun to hit their stride in terms of returning, crude runs and refinery utilization back to historical levels. Again, if this outage had been far longer, we would have seen a much more significant hit. And it's important to note as well that while stocks were definitely tight in the East Coast for gasoline, they weren't abnormally tight. And a lot of what drove prices higher, a lot of what drove the sort of, the excitement around a storage, if you want to call it that, was really around people just reacting. You probably saw memes of people putting gasoline in hot tubs and plastic bags, et cetera, and creating gas lines. So it really was that perception of the shortage less than the actual reality of the shortage that really drove this situation and sort of prices to go higher, essentially. And this gets into what is this interconnection between regions when it comes to refined products in the US. And as you can see from the map here, the refining centers are centralized in the Gulf Coast, Texas and Louisiana. There's a bit, of course, sort of around Cushing in this Oklahoma, Kansas area, a good bit of refining capacity, not nearly as large as the Gulf Coast, in Southern Illinois, as well as Northern Illinois and Indiana. And then, as I mentioned, that sort of shrinking refining capacity center in the mid-Atlantic states and around New York Harbor. So this means an increasing reliance on refined product flows from Pad 3. So going from Gulf Coast Pad 3 into East Coast Pad 1, the Colonial system is the major system. There is the Plantation system, that's a 700,000 barrel a day line that ends in Virginia. So that line can provide some relief, but just like Colonial, these lines typically run nearly at full capacity. And so when the Colonial system was down for those few days in May, Plantation was already running at full rates. And one thing to note is that not all terminals have connectivity to both pipelines in these important retail areas like Atlanta, like Tennessee, North Carolina, et cetera. So that can create, especially in that example I gave of 2016 when the line was down for over 2 weeks, that can directly have some supply disruption impacts there. Now, New York not only is this receiving end of supply from the Gulf Coast, the very tail end of Colonial Pipeline, but it also is a point of delivery for supply into upstate New York, into parts of Pennsylvania. So it's a very important throughput point. We have had steady, waterborne imports, both of gasoline and diesel that typically flow in, but the region has become more and more reliant on those, especially because of the fact that to move product, if prices are high enough in New York versus the Gulf Coast, they have to be even higher to really support anyone loading a cargo from the Gulf Coast to take it to the East Coast. And the reason for that is the U.S. Jones Act, where movements between U.S. regions on waterborne ships have to be under a U.S. flag. And U.S. flag vessels are short in supply and are fairly expensive as a result on a freight rate basis. We did see some Jones Act waivers that were granted during this outage period, just immediately after. Those are granted from time to time, but it takes something very significant and acute for those to be granted. And that's why there is this reliance between the heavy demand center of the East Coast that's short supply and the Gulf Coast on these pipeline systems. And into Pad 2 is also mid-continent, is also reliant upon supply from the Gulf, with supply flowing into Tulsa that then is distributed to that western part of the Midwest region and then going into Chicago. And Chicago, of course, does have its own refining system as well, but also relies on those movements from Pad 3 to build stocks and to balance demand. And it's also geographically isolated. There are barge movements that do go up the Mississippi River, but again, you're limited by size and you're limited by cost to a certain extent when it comes to those waterborne movements. Finally, you have Pad 5, which is sort of off on its own, an island unto itself. Pad 5 is a refining center in the West Coast between both, Los Angeles and San Francisco. You've probably seen in the news in the past 10, 15 years, when a refinery goes down in California, we see a huge jump in those regional prices there. It's because of how vulnerable the system is to those supply disruptions. Not only do those refineries, along with the needed imports, supply refined products to the very large demand center of California, but it also supplies gasoline and fuel to Las Vegas and Phoenix and Tucson and those urban areas of Arizona. So this also exacerbates when there is any kind of supply disruption into the West Coast. And as well, you have not only the U.S. Jones Act, which makes it sort of cost prohibitive to move product from the Gulf Coast to the West Coast. It does happen from time to time, but the prices do get high enough. But you also have geographic constraints too, with any of those flows having to go through the Panama Canal before finally making it to Pad 5. So just want to paint the picture of really, the Colonial Pipeline incident illustrates the interdependencies and how vulnerable the system is, just based on not only those geographic constraints, but just on the other constraints around waterborne and that reliance on pipelines. And crude is very much similar in that. So on the coast, you have really little to no connectivity to those producing regions, those domestic producing regions in the middle third of the U.S. In recent years, there was an increased reliance on Bakken flowing by rail from North Dakota into the East Coast. And there's still a bit of that still happens, but it's not as economically feasible, just given the cost of rail and then that relative price difference between U.S. crude, essentially WTI, the U.S. benchmark, and then Brent. When you look at the middle third of the U.S., if you were to turn the calendar back to 2000, 2005, the map was very different. So you didn't have these production centers in the middle third of the U.S. domestically, no Bakken, no Permian, no Eagle Ford, et cetera. You had a bit of Canadian production coming down, but not the level it is right now in terms of oil sands. So the flow was actually north. So you would have imports coming in. Sometimes I believe imports back in the day were on the order of 10 million barrels a day in some years, imports coming in. And then these pipelines that are in red flowing south were actually flowing north at that point. So pad 2 was the ultimate receiving end because that's where the crude was needed to effectively keep running refineries and to meet consumer demand. Now, with the proliferation of tight oil, with the proliferation of West Canadian sedimentary basin, the pipeline flows shifted to where now, Canadian crude, I'll get into that interdependency between Mid-Continent Canadian in the next slide, but on the order of, 3 million barrels a day of flow from Canada into PAD 2. It's a staggering amount. And then you have crude flowing to the Permian into PAD 2. So PAD 2 is still receiving from those two locations, but much of this Canadian crude and this Bakken crude, et cetera, ends up flowing all the way into PAD 3, where you have a larger refining center. And also now, since 2015, there is the ability to actually export. So Canada is the largest source of US energy imports, and most of this is by pipeline. The Enbridge mainline system is incredibly substantial and is necessary to supply PAD 2 in total. As I said, there's an average of about 3 million barrels a day that's flowing into PAD 2 in the region. This is based on our real-time pipeline monitoring that we cover for majority of the crude pipelines in the U.S. But this dependency also runs the other way. Eastern Canada is dependent upon lines that actually go through U.S. territory. If you see the graph on the right, this is an analysis that we did based on line 5 and what a potential closure of line 5 might mean to the Sarnia refineries. It's a large refining center in the demand intensive region of Ontario in Canada. So this year, the governor of Michigan essentially ordered the closure of this line, and this line supplies 500,000 barrels a day plus from Superior coming off the Enbridge system that's bringing both Canadian crude as well as Bakken crude into the U.S. and would essentially deprive this region of these grades here for anything from heavy crude to light crude. So it's still being debated as to what is actually going to happen because, there's U.S. cross-border restrictions. It's a very touchy legal issue, and I won't get into that. What I'll talk a bit about is what it actually means. And it could be a bottleneck for not only the Enbridge system to, just to effectively balance out and not be entirely full flowing in, but also would deprive those refineries in Western Canada that essentially provide, nearly 200,000 barrels a day of gasoline and 130,000 barrels a day of diesel into the Ontario market. So it's fairly significant. And what it illustrates is that, this system is balanced and is delicately balanced, and any sort of short-term or long-term supply disruption given geographic locations, given where refining capacity is built relative to where demand is, can have a significant effect on both price and the ability for refiners to provide fuel and for prices themselves of what consumers end up buying at the pump. So we have a recent example of that mid-continent to Canada dependency. In October, November of 2019, there was a leak on the Keystone Steel City to Patoka line that goes here. And this line comes off of the major Keystone system and supplies in Patoka refineries like Wood River, et cetera, that are critical to overall supply in the mid-continent region. So the line was down for several weeks. It didn't have a huge impact, and it mainly was because this was during planned maintenance season. This happened to occur during planned maintenance season, where typically in the fall, once the summer demand season is complete, refineries will take down capacity for routine maintenance. And also during this time period, as Clay mentioned, you have these shock absorbers, right? So a lot of these supply disruptions depend on context. In the colonial context, it's tight supply and demand roaring back, which made it more acute. But in this situation on the crude side, it's a time when refinery utilization is going to be seasonally low and some units are already down, and you had enough stock cushion to where this didn't have a significant impact. But that's not to say if something like this happened in the heat of the summer, when refineries are running at the highest utilization levels to meet seasonal demand for gasoline, something like this, and of course if it was 2 weeks or longer, could have a significant impact, and just again highlights that dependency of these pipeline systems and those dependencies that are between pads. And finally, turning on to what's in my neck of the woods, is the Texas freeze. So you have record temperatures. Temperatures not seen since I've seen records from 1989. I've seen records going back as far as the late 1890s in terms of how cold it actually got in Texas. And one thing to note about Texas, I'm sure you've read the news about this, is the ERCOT grid, which is what supplies power to most of Texas, is separated from the national grid. So a combination of factors led to capacity being shut down to avoid a catastrophic failure of the grid overall. Combination of wind, combination of freeze-offs. Basically, these power outages and the low temperatures affected nearly every part of the supply chain, from production to pipeline pump stations, all the way to refineries and petrochemical facilities. And what took the longest to come back was not necessarily production or those pipeline pump stations. It was the refining capacity as well as the petrochemical capacity. The refining capacity we did not see really fully recover until sometime in late March. That kind of outage for that many days took that long for refineries to recoup back where they were. And this was happening at a time when we saw fuel demand relatively low in January and February from the freeze, as well as from impacts from the pandemic and rising cases, to where March was a very strong month for demand. So this is happening in the background, and of course, drawing on stocks as well as supporting rising prices. The petrochemical industry was actually hit even harder. It took far longer for those ethylene crackers that are located in the Gulf Coast to recover, where we didn't see the capacity really coming back to sort of pre-freeze levels until really April, mid-April. It almost took two months for that. So while ERCOT is a bit different in terms of its grid from maybe other ISOs in the rest of the US, it does highlight the reliance on all of energy infrastructure, from production all the way to deliveries of product, at the rack by truck to retail stations. How reliant we are on grids, and what an outage, even for a matter of 3 or 4 days, can do to the overall ability for the industry to deliver crude to refineries and then deliver product to consumers like you and me. So with that, in conclusion of the U.S. midstream and downstream space, and what can we do, or what can be done, or what are the challenges that we see ahead? I've seen a lot of talk lately about why don't we have additional pipeline capacity to move product all the way from New York Harbor, from the Gulf Coast. And if you've read the news in the last 10 years and what I mentioned about Line 5, not only are there regulatory challenges to new pipeline builds, but there's also, this not in my backyard viewpoint that, yes, we need them, but no one wants it to be in their neighborhood, for reasons of worries of an environmental impacts. So Keystone XL, which I just saw, is finally, after 8, 9 years is finally officially canceled, although it was pretty much done several years ago, unfortunately. Dakota Access and the legal battles and the protests we've seen about that, this sort of battle between the governor of Michigan and Enbridge around Line 5. There is a need for additional capacity to be built as a cushion. But those regulatory challenges and those societal challenges make that difficult. I mentioned, waterborne movements. Because of the U.S. Jones Act and U.S. flagged vessels, that increases the cost and as well as the available supply of ships to move product between regions. Barge movements are fairly frequent from the Gulf Coast to Florida. Because Florida, of course, Florida's off the pipeline grid entirely, relies on those waterborne movements, but those are barge movements. But anything longer than that has to go into open ocean requires a tanker, not just for economies of scale. And cabotage does have an effect on, how quickly the industry can respond when there is this kind of supply disruption in a pipeline, for example, or something more significant in PAD 1, like a large refinery outage, and how Gulf Coast can supply the US East Coast. We did see crude by rail becoming a thing in 2014, 2015. But a lot of that was based on just economic advantages because you had the WTI benchmark so far below the price of Brent, the European benchmark, that it made sense for refiners to buy Bakken plus freight into the US East Coast. That still landed cheaper than buying a cargo of imported crude. But that has not been the case for several years. Rail is relatively expensive. And while unit trains, which are about 65,000 barrels a day of crude that can be completely loaded with crude and move, to refining centers, that's cost effective. It's not the same when you have individual cars for refined products, et cetera. And if you've seen the news recently around these recent board meetings at Exxon and Shell, energy transition is taking center stage, and these companies are being asked, what they're doing to combat climate change and carbon sequestration. So the challenge is to raising capital to build these necessary relief points along the U.S. midstream system, both for crude and for refined products, are just going to be more challenging, just given that societal push. So with that, I will turn it over to Clay. Thank you.
Suzanne, that was fantastic. Thank you so much for the overview, for the backup data, and the perspective on the networks, their interdependence, and in fact the vulnerabilities that are built into our system, and we should be mindful of for sure. I have a question for you that I was thinking of in a related sector, which is the downstream, and I'm just wondering what you think about this. I mean, on the refining side of oil, there has been quite a bit of rationalization, really all around the world, but also in the United States. We had a refinery in the East Coast that shut down altogether, I think in 2019. Other units in the United States are kind of being repurposed from traditional, let's say fuel manufacture. But I'm seeing like a contrast with certain other areas of the world. So in places like China, in the Middle East, there's actually brand new refineries coming online, becoming crude consumers. When it comes to the United States, what do you think? Are we actually losing refining capacity in the United States? Does that amplify the vulnerability going forward?
So what we've actually seen the last year is more the Philadelphia Energy Solutions example was more around the fire and the level of damage and just the difficulties in running a refinery on the East Coast, where you're not near to those crude advantaged areas like the Gulf Coast has with Permian and Eagle Ford on your back door. So your crude cost is higher and you face a challenge on margins. Where we've seen refinery capacity rationalization in the US in the last year is your smaller refineries and refineries that haven't been as economic as other refineries due to level of sophistication, et cetera, due to their location, and those moving towards renewable diesel. With the LCFS regime and that credit structure in California, it is quite profitable to take soybean oil or palm oil, et cetera, and produce renewable diesel, get those credits, and that is quite profitable. So Marathon Martinez is an example of that. Based on how margins are coming back, we're not looking at any rationalization of your larger refiners. What I think would be important to watch is what is happening with the renewable fuel standard and what's happening with this debate around small refinery exemptions on renewable volume obligations. Those were in place for several years under the Trump administration. They're being debated in court right now. There are some concerns around just the price of just commodities in general, agricultural commodities, as well as what those renewable volume obligation requirements will be for 2021. That's added a lot of volatility and really lifted RINs prices and that renewable obligation value. So if we don't see small refinery exemptions coming into play, and we see the RINs and this commodity inflation on the agricultural side continue, that could be a threat to your smaller refineries. Where we do see the biggest threat to rationalization is not necessarily in the US globally, it's actually in Europe. And that has to do with the pace of the energy transition in Europe and the electrification in Europe as well. Europe has been able to find a home for its product in the US, and it's definitely the case now as we have demand in the US recovering back quickly, Europe recovering but lagging somewhat, and those two should begin to normalize when we get more into 2022 in terms of returning to normal levels on the European side. But that's where we see perhaps the largest threat is in Europe when it comes to refinery rationalization.
That is really helpful perspective. Thank you.
Sure. So
Okay.
I have a question. Oh,
no, go ahead, Suzanne.
I was going to ask Clay something real quick. So we talked about the Colonial Pipeline closure. You and I both talked about it. And of course, we saw more gasoline coming to the East Coast from other countries, but not a major wave like we've seen with that refinery fire in 2019 or when we had that Colonial Pipeline outage in 2016. So why didn't more cargoes get pulled into the East Coast, in your view?
Oh, during the Colonial outage then, right.
Yes.
Yeah, there's probably a couple of factors that influence that. I think the first one is that the market accepted and expected the company's guidance about a very short-lived disruption duration to come true. In the end, that is what happened. So I think a lot of companies were placing a bet that the arbitrage opportunity, an exceptional one, would not really be in place, and that some guys maybe shipping extra cargoes would find those trades to be, upside down or at least marginally profitable if they had sent a big surge and then there was a quick restoration, which there was. I know my friends in Atlanta and southeastern markets might not agree that Washington, D.C., that it was fast, but in oil market disruptions, relatively fast. So if they had sent a whole lot more, that would have threatened the economics and profitability of those cargo trades. And so I think the market had that right, or at least they were on the right side of that bet. The other thing too to keep in mind is that, and you'll know this as well, because this is y'all's wheelhouse, but it was really those kind of inland southeastern markets, more than maybe the East Coast metropolitan big cities, that were facing the crunch from Colonial. Sure, it goes all the way up to New York Harbor, but the main guys that were maybe running empty at gasoline stations were in kind of Appalachia, the southeastern, and it's not super easy to resupply those markets and get all the way to those retail stations by just landing gasoline and blending components into the harbor, into Providence and Delaware and other East Coast locations. Even to a certain extent, we did see a few more in areas like Charleston and Savannah. Some came out of Caribbean storage and right up to those southeastern ports. But I think that those two factors together, a little bit difficult to resupply the inland markets with big waterborne shipments, plus the expectation for a quick restoration, explains that outcome.
Great. David, you have some questions for us?
Well, thank you, Suzanne. Actually, thank you, Clay, as well, for excellent presentations. This is time to open things up for questions and answers. There is a distinguished group of listeners today. and would kindly ask you if you've got questions on the top of your mind to put them to our presenters. There is a question from Will Jackson. He asks, is there any evidence that the climate change anti-fossil fuels movement is partially motivated to destabilize future energy markets in Western nations? Very good question. Would you both care to make a quick response?
I'll start. I'll opine on that. The question was specifically about evidence of a motivation. I certainly haven't seen any such evidence. I found it rather compelling. The human-caused or anthropogenic 2 degree Celsius and 1.5 degrees Celsius targets that are in Paris in order to arrest the rapid climate change to be pretty persuasive at face value. So again, I'd like to consider all sides of every story and all perspectives. If there is such evidence, or even the possibility of such evidence that there are motivations to kind of harm the national security side in the West, I certainly haven't seen any.
Yeah, I would say the same. What I would say about the energy transition in general, is there's a view that these steps need to be taken towards carbon sequestration. And we'll see how consumers react. I think at the end of the day, and even Clay brought up that point, there is pressure on the oil companies themselves to respond, but ultimately consumers hold the power. Will I buy an EV? Will I buy an ICE, an internal combustion engine vehicle? And how quickly will I do that? And am I incentivized to do that? So I think that's what to watch necessarily more than where this is coming from, but how will consumers respond? Because I always get the example of it took a long time to move from, whale oil for lamps to kerosene. So these transitions like we had, especially as well with moving towards renewable fuels in 2005, these transitions are never smooth. They are always messy, and there are always, situations and disruptions and consequences we're not able to perceive. But at the end of the day, I think whatever happens with this climate change is going to come down to what individuals essentially do, be it in major Western economies or be it in emerging economies.
Very good, very good. Well, one of our listeners is asking if the slides have been posted, and they have. They are readily available for you to download at any time now. Put your energy security hats on. Andrew Slaughter asks, do you think refiners and pipeline operators have lagged in their cyber risk protection?
Hey, Andrew, good to hear from you. Well, there certainly is some recent evidence to that effect, because a major infiltration obviously did take place. And, as I said in my remarks, the focus on these defenses and kind of standardization of the defenses, so that it's not every man, every company, every pipeline for itself, I think is the wave of the future. Clearly, the federal government and through its national security lens is now acutely focused on the way these midstream asset operators are protecting the assets. And so I think that that's really the wave of the future, and certainly the short-term focus.
Yeah, I would agree with that. Yeah.
I actually have a little bit of a riff on that, and maybe I can ask Suzanne and their kind of pipeline expertise at Wood Mackenzie. But you mentioned all the, I guess in economics, externalities that come into the discussion about whether to add more transportation supply, specifically in this case pipelines. A lot of opposition to building new. Would you agree that, though, in isolation, like just looking at the economics of supply and demand and the structural disconnect between the Gulf Coast production center and the demand centers in the East, from an economic standpoint, there is rationale to have additional connections, right? Putting aside NIMBY, not in my backyard, regulatory concerns. Like, why is it so Colonial and Plantation together are substantial, but how many tens of millions of people live in those markets that require that transportation from one region of the country to the other? And there's some big vulnerabilities there, right?
Yeah, and the system in terms of the Southeast works well when things are running normally and running at full, which they always do, but then it's vulnerable to that sort of thing. So, the East Coast has been reliant on imports of both gasoline and distillate, especially in times of high demand or supply disruptions. But they're consistently reliant, and more so with that Philadelphia Energy Solutions refinery going offline. Monroe Trainer, that refinery, took down a CDU for economic reasons last year. So with that shrinking refining capacity and the fact that New York Harbor not only just supplies that largest metropolitan area in the US, but actually supplies a good portion of upstate New York, as well as other parts of the mid-Atlantic and the needs of the Southeast, it does make sense for these pipelines to either expand or to have additional capacity. So that import need would be something that would be more marginal and based on demand fluctuations, or it would be a temporal thing as opposed to being a consistent thing. That wouldn't be great news for European refineries, but it would be better for the East Coast.
Very good, very
Good
good.
point.
Well, I think we're just about out of time here, and I'm not seeing any other questions come in. For Clay or Suzanne, do you have any other last-minute questions or comments that you wish to make known today? Okay, hearing none. Wish to thank you both very much, in particular Vortex's engagement with IAEE on bringing about this webinar. We do truly appreciate your membership in the association, your expertise that you bring to the table. Suzanne, my first encounter with you, quite impressed with your research and your understanding of the industry. These are definitely interesting times for our association, particularly as we embrace on just a whole facet of topics on energy transition. And it's a particular passion of mine that I see that our organization spend more time and effort on doing research on this particular topic. So with that in mind, I thank you both very much for your time. And for those listening still, this has been recorded, will be available live on our webinar rewind station this afternoon. I wish you advance wishes for a great coming weekend coming up here. Thanks very much.
Thank you.